Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I am delighted today to have special guest Chris Watling, CEO and founder of Longview Economics, with me, one of the smartest research houses on the street. Welcome, Chris.
Hi, Paul. Thanks for having me. I appreciate it. It's good to be on.
Now, sort of big picture-wise, we've got this sort of like tug of war going between the reopening of the US economy and the rise of infections against the sort of like the huge amounts of sort of central bank and government support. How do you see the shape of the economic recovery progressing over the next 3 to 6 months? And what type of sort of letter of the alphabet is it going to be? Sort of like a U, W, or even a Nike swoosh?
The Nike swoosh, yeah. What a great question. I mean, and so key, so important. I think the interesting thing is, and what we've been asking ourselves in various countries around the world is this sort of fiscal fill-in versus GDP hole. So who's done enough, who hasn't done enough, who's going to create a V, who's going to have a bit of a limp V, and so on. And, I think what's intriguing is to my mind, the work we're doing suggests the UK is behind the pack. So somewhere like America, the stimulus is large and big. It's double-digit percentages of GDP. There's $1,200 stimulus checks into people's accounts. It's an awful lot of money they've been putting into the system. Whereas in the UK, I think we're probably about half that, even after the sort of extra sort of mini summer budget, the £30 billion giveaway, £30 billion, giveaway that we saw from Rishi last week. So I'd say we're a bit of a limp V in the UK. We may actually become a bit of a W if we're not careful. Whereas the US, I think, is much more of a punchy V, and perhaps the same in somewhere like Japan and potentially even somewhere like China as well. So they're real differences. Germany's very different as well. They've got a very different furlough scheme from the one we operate here. It's kind of indefinite. So it has a very different effect on the way the economy plays out.
And is there any precedents in the past that we can sort of draw on or guide investors? I mean, I remember sort of the great financial crisis, we sort of like took ages putting in TARP, which was a real problem, but then you had a real massive bounce in the banks. But here we've got this really sort of like, almost like cliff edge fall for the economy in 1 or 2 months with a massive amount of unemployment. And then we've had this really sharp rebound on the stimulus. Or are we really still sort of this twilight zone of sort of like, between reality and fantasy, and we're in uncharted waters and we're going to have to play it as the data comes through?
Well, yeah, you're absolutely right. We're sort of on that stimulus high, and we're going to get the furlough cliff in the UK, and that's going to be a very different. It is going to be a big hangover. So it's hard to see unemployment not going to at least double digit, and maybe going to the highest we've had in terms of unemployment rate on record. So I think in the early 80s we're 11% and change, something like that. Our range of forecasts is 10.5% to 14.5% in the UK post-furlough cliff as we get sort of Christmas time. So that's going to be pretty unpleasant. But in the US, it's very different. So, that stimulus high, there's so much of it. And actually the contrast comes through loud and clear. If you look at a month-by-month consumer spending forecast in the US, it gets above January's levels in the second half. In the UK, it doesn't really get anywhere near our January levels in the second half. So the amount of stimulus, you can see there's a real contrast. But it's not. But it's certainly not. Is there any precedent? It's certainly not the GFC. It's a completely different type of recession. And as we've been saying to our clients, this is a supply side shock that might morph into a demand shock in the UK. Might do elsewhere, but stimulus suggests it probably won't. And that supply shocks are very rare. Most recessions in the last few decades are demand shocks, not supply side shocks. So you actually need to go back hundreds of years to get a sort of pandemic equivalent lockdown type recession. So there's no great precedence on a really simple scale now.
Yeah, and I guess the sort of like the big question mark is going to be how quick we can get a vaccine. And if that happens, it could be the real gatekeeper to accelerate this recovery. I mean, they may still have challenged areas and companies and sectors with massive amounts of debt. I mean, crikey, the governments are going to be sinking in the amount of borrowing that they're going to do coming out of it. But the quicker we get that, the faster the recovery really across the world, I imagine.
Yeah, I think that's a massive play into confidence and into people's desire to go out and spending and get that consumption up and get the household savings rates down. That's utterly critical. And I think even in the last 3 months or 4 or 5 months, when we initially started this pandemic, one sort of assumed we'd be locked down for 2 months, so we'd bounce back to normal fairly quickly. But it's become very clear over the last 3 months that business models have changed. You know, restaurants, you're social distancing, there's no sports events, there's social distancing and queuing for shops. So a vaccine would change that dynamic and get people spending and going on holiday more and so on. So really key.
Okay, so bringing all that together, how is Longview actually playing the relevant assets, the allocation between sort of like, you know, bonds and equities, currencies, commodities and cash? I mean, my own personal portfolio, I'm heavily into equities and cash, but how does Longview actually see the asset allocation there?
Well, I mean, in terms of sort of strategic sort of 6 month, 2 year asset allocation, at the moment, we're biding our time a little bit. We're kind of neutral. We've had a really super bounce in equities, as you've seen, really as you've priced in the unlocking of the economies and the stimulus that's been coming through. And at the moment, I think the market's digesting, and there's a real key decision point coming up in the next few weeks, month or two, when we decide whether cyclicals are in a place to lead the market higher, or indeed whether tech is going to crack. It's clearly very toppy. It's got a lot of momentum. There's enormous moves in tech stocks in the US, or indeed if defensives are going to come to the fore. So that's really key. And I always like to think of the market as really three sectors. There's sort of long duration growth stroke tech is one. Secondly, the cyclicals, and thirdly, the defensives. And actually the bond yield is quite a good dividing line between how you rotate amongst the three. So long duration growth obviously likes low bond yields. Defensives like low bond yields. Cyclicals like rising bond yields. A very clear correlation between banks and bond yields, for example. Yeah. So, you know, I think one's view on where bond yields go in Q4 is really, really key. And of course, there's a couple of things playing out there. One is, you know, you've got to look to the US, of course, because they lead the charge. One is, you know, are we going to get another stimulus package out of Congress? And probably yes. So that's a growth impetus pushing yields up potentially. And secondly is, as you say, are we going to get close to a vaccine, a bit more confidence coming in, more spending, more growth that way? And I think if you get all those, we're probably looking towards a Q4 led by cyclicals and rotation out of tech and long duration growth.
And when you say cyclicals, you mean basically the beaten down sort of industrials and banks and house builders and maybe even the energy sector, all those sort of like areas that.
Exactly. They're all in there. They're all in there. So you can literally take the top. There's lots of different ways of categorizing sectors. There's top level 11 sectors on the main categorization. And you go down to industry groups, 25 and down again. I'm just really thinking top 11. And within that, you know, it's really anything you'd think of: energy, industrials, raw materials, commodities, resource stocks, all that sort of stuff. And consumer cyclicals, although not, you know, you'd exclude stocks like Amazon from that, which is really a tech pandemic stock these days. It's not really a classic consumer discretionary, consumer cyclical. So all of those go down into those subsectors you talk about. Yeah. So it's a broad church.
Okay. And what about sort of like potentially combining the two, having tech focused in these challenged cyclical areas? And it may well be, I don't know, a sort of like a residential property portal or a Priceline.com, which does hotel bookings, or at these areas that are so challenged and still beaten down, but they have sort of tech orientation. I mean, that may be another area you could combine even the two and get the best of both worlds.
Now, I mean, potentially that could work. I mean, that's down to single stock analysis. We're not single stock guys. We're sort of macro sector guys, really. But yeah, I mean, if you can find that kind of company that fits those criteria, it may well hedge you against both. Obviously, you'd want to look at how much it's already priced in and whether it's behaving more like a tech stock or more like a cyclical. So, you know, if it gets caught up in the tech euphoria, great if that continues. But if bond yields back up and you get rotation out of tech because it's so overstretched at the moment, then you don't want to be in that kind of stock. Yeah. So you've got to judge it case by case, I think.
And the cyclicals you're talking about, you'd buy them as ETFs, would you? Through those, effectively, that would be the way to do it. So you get a broad spread across the sector and get the exposure of the cyclical rather than actually individual idiosyncratic risk of a potential company.
Certainly from our point of view, yes, we're not analysing individual companies, so we don't want to get that sort of specific company risk. We want the sector risk, and an ETF is a great way to do it.
Okay, so coming on to it perfectly, I guess, really, with the Q2 results season, we've got the banks kicking off, the US main money center banks tomorrow. We've got Citibank, Wells Fargo, and JP Morgan, and I think later on in the week we've got the other, big institutions. How do you see that sort of banking results faring up?
Well, I think this is utterly critical because what they say about loan loss provisions and their outlook, I think, is key. So, as I said earlier, this is not the GFC. This is not a banking crisis. And in fact, governments have taken quite a lot of risk onto their own balance sheets and off the banks. So you look at consumer credits being paid down a lot in this crisis. Governments are doing the lending to businesses, coronavirus business interruption loans and all that sort of stuff. So banks are probably lower risk. They'll clearly have rising loan loss provisions or challenges there because, people are challenged. But, it's really key, I think, to get a sense of how strong they're going to be in the second half, how much they've got to charge off, and how we're going to look. So how inclined they'll be to lend money as the government moves away from providing the loans and the stimulus, the commercial banks come back in. So this week is key. We've also got Microsoft at the back end of it, which is always an interesting stock. So plenty to watch for. Off we go on Q2, and of course outlooks are key. So a lot of the outlooks were not given last quarter. Companies withdrew their outlook, very unusual. Are we going to get some more of those outlooks going forward? That'll be interesting.
Okay, and then sort of like the the visibility of it going into the year end. We've got the US presidential elections, and we've got Joe Biden, who's now sort of like almost a shoo-in into according to the UK bookies, is about 65% probability of him moving into the White House in November. How do you see that and many other risks at all for the Q4?
Well, Biden is definitely a risk for markets because he's made all these comments about capitalism and a desire to unwind some of the corporate tax cuts, which will hit corporate earnings and so on. So there's plenty of risks there from Biden. But you have to remember that actually, if you look historically, when a challenger to the president, the other, whether it's Democrat or Republican, when he comes through the primaries and actually struggles to start with, it's not as obviously a shoo-in as you would imagine. So I'm slightly skeptical about the polls. I'm not sure they'll look like this in 3 months' time. Trump is, of course, a fantastic campaigner. Give him that. He's very good at standing up in a debate and taking on the incumbent. And Joe Biden, we know, has a problem remembering his lines. So I think those presidential debates will be challenging for Biden. That may well change the polls. And the fact that Biden didn't do well initially in the primaries is not a good sign. So yes, it looks from the polls like Biden's a shoo-in. I'm not so convinced, but it's definitely a risk for markets if he does come into office.
Yeah, it does seem as though the bookies are saying one thing, but the markets seem pretty nonplussed, and there's no major seem to be worry of a Republican being, Democrat moving into the White House.
That's right.
Yeah. So I'm positively biased towards the market in terms of I think there's going to be a medical solution earlier than some others participants as investors wise. But with regards to protecting yourself, hedging yourself in the market, you've got this. If you're looking for opportunities and you want to sort of like give yourself some downside protection, how do you do that given the strong asset correlation between equities and bonds and and most other assets like gold? They all fell off in March.
It's very difficult. It's, really since we financialized the system 10 years ago, really, when the Fed's been buying everything, pushing people out the risk curve, it's become increasingly harder to diversify yourself. But it's not impossible. You can do certain things if you like engaging and using derivatives. They're dangerous instruments. You need to understand what you're doing, but you can buy deep. One way, for example, you could buy a deep out the money put option on tech stocks. So you get it pretty cheap, I think, because volatility is pretty squashed. You buy deep out the money because if it's going to crack, it'll go hard if it really does crack, for example. So, I like to look at Nikola as a great sort of concept stock that goes up 10%, down 10%.
They are sort of like a hydrogen fuel, sort of like truck manufacturer, is it?
Exactly. They're sort of the truck version of Tesla, if you like, on a very simple basis. But they're sort of 30, 40 billion market cap company that moves up and down 10, 15% a day.
Which is bigger than Lloyd's.
Which is extraordinary, I know. It's unbelievable. And I'm pretty sure they haven't got any revenues as of yet. I need to check that. But
yeah.
Yeah, so it's a concept stock. This is classic late 1990s. It's got all the sort of feel for it. Retail traders are going nuts. Tech stocks are being bid up hard. You know, there's a mania building. I mean, you look at the number of account openings of day traders in America, Germany, Sweden, they've exploded over the last few months. So, you know, liquidity's fueling tech boom. With the end of a growth cycle, you know, maybe it goes on for a few more quarters. But it might not. And if bond yields back up, you could get a big pause or some big give back in this tech rally. And it's pretty overstretched in the near term. So I think it's a good hedge. I wouldn't want to bet hard against it with futures, but it's a good hedge. And I think you can buy deep out the money puts on NASDAQ as a kind of slightly unusual hedge, if you like. I mean, you can do your classic bonds and equities, because if markets really do fall, bond yields will go down temporarily. So yeah, there's a bit of that. March, everything sold off in March on the credit crunch because there was a shortage of liquidity. And I don't think you'll get that kind of scenario again near term because central banks are so on their liquidity game. So yeah, you know, you can be clever. There's lots of things you can do. Those are the sort of things that I think are interesting. Maybe deep out the money calls on gold, stuff like that. Bitcoin, perhaps.
Okay, and then sort of like quite a few in Vox investors who do a bit of or dabble in the dark arts of day trading. How do you see? Because you obviously have a microscope into the hedge fund world, into the professionals. What do they sort of like use to give, you know, to help them with, say, maybe alternative data? What other sort of instruments and tools do they use for this sort of like, you know, on a daily battlefield basis of the markets?
Well, they use a ton of stuff. There's a ton of different styles. There's obviously a lot of algorithms out there where they have equations that basically determine, and those algorithms tend to be sophisticated versions of short-term versus medium-term moving averages. And they're just looking for crossings and they're testing. I mean, there's a whole bunch of stuff. Jim Simmons' book's quite good on this. Not his book, the book about in the, I think the bank, the man that broke the bank. I forget what it's called, but it's just come out recently. I read it. It was very interesting. They give you some insights into how some of these hedge funds work. Yeah, they do all sorts of stuff. Alternative data. We like to, we do our risk appetite models, which is sort of fear and greed. And some of the hedge funds we have subscribed to those. And
how do you measure fear and greed?
We basically measure the market's appetite for risk every single day across the globe. So we take maybe 150 data points every day. We look at how 150 prices move relative to their current level of risk, so their current volatility level, and we sort of mash it all together, and it produces the market's actual appetite for risk. So some people say it sounds like a sentiment gauge. It's not how people feel, it's what people actually did on a measured basis. And the market has sort of different moods, and it tends to ebb and flow between greed and fear. And sometimes it sort of gets greedy and stays greedy, and that tends to happen before big sell-offs, or it gets fearful and stays fearful, which tends to be.
Is it greedy at the moment?
No, it's kind of mid-range. It's normal. It's not. I mean, it was very greedy at the start.
What about Nicola? It must be greedy around Nicola.
Yeah, I'm sure it will be. We don't do it. It doesn't work on individual stocks, but it works on markets in general. But yeah.
And what about March?
I mean, Amazon.
Yeah. What about March? When we hit March the 23rd, I mean, I'm guessing that was deep fear.
March 23rd, we had some of the, well, basically we had generational strong buy signals. I mean, literally strong, like some of them stronger than in 09, some of them as strong as the depths of the 87 crash. Basically the sort of top 2-3 data points on record.
And what about sort of like longer term going forward? I mean, I use sort of like the yield on the US BBB corporate bond index to give me an indication of the stresses in the market, particularly in the bond market, and then also the PMIs and sentiment. So sort of like the direction of the sort of the market rather than an individual day basis. What do you use as sort of like a top level?
There's a ton of stuff, to be honest, but I think BBBs are good, or the high yield spreads are interesting. All that sort of stuff gives you a sense of how much stress. You can look at the repo rates or TED spreads, or there's so much stuff you can look at. We publish every day our daily rag that has a lot of this information in it, and that gives us a good sense on the sort of day by day, along with those fear and greed models. And watch the macro. I mean, there's so much macro that matters. PMIs are important, but they tend to be more coincident than leading. And Really, you know, look at the steeps, the yield curve, you look at the M1 money supply, those things tend to lead a little bit better than and tell you where the PMIs are going to go. So, yeah, you know, we published 9 publications. They've all got different inputs and thoughts and thinking. And there's a lot you can look at.
Well,
it's an art form.
Yeah, I can hear you've got a fan in the background who certainly likes those 9 publications. So
yeah, that's right. Yeah, sorry.
That's all right. Yeah, no problem. Well, thanks very much for your time, Chris. And just finally, where should investors contact you or Longview if they want to be interested in some of the products?
Yeah, so longvieweconomics.com, info@longvieweconomics.com for an email address, or if they're interested in short-term trading, shortview.com, daily rag subscription, or click onto our video on the front page of longvieweconomics.com. We have a free daily video on our sort of thoughts for the day for sort of short-term traders. It's free to subscribe to. Go onto YouTube, search under Shortview Trading. Click on become a subscriber. That would be great, and let us know if it's helpful, if there are other things you want to hear about. That'd be great. We'd love to be of assistance.
Okay, great. Well, thanks very much for your time, Chris, and we'll speak in about a month's time once we're through the Q2 results season.
Brilliant. Look forward to it. Thanks a lot, Paul.